Cryptocurrency has become one of the most talked about financial revolutions of the decade. Yet for many people, it remains a confusing, risky, and sometimes intimidating space. The truth is, with the right knowledge, strategy, and mindset, you can safely invest in cryptocurrencies and even build long-term wealth, starting in 2025. So let's break everything down, from understanding the basics to developing a strategy that minimizes risk and maximizes profit. If you've ever wondered how to get started, where to invest, and how to protect your money from volatility or scams, this guide is for you. First things first, let's talk about why cryptocurrencies are still worth your attention. Some might think the crypto boom has come and gone, but that couldn't be further from the truth. Bitcoin, Ethereum, and countless other digital assets have fundamentally changed how we think about money, decentralization, and financial freedom. Traditional banks? They're slow, expensive, and loaded with fees. Crypto is global, fast, and, if you know what you're doing, extremely profitable. Not to mention major companies like Tesla, PayPal, and even Visa are embracing digital currencies, which shows this isn't some temporary trend. So, how do you actually start investing safely? Let's start with step 1. Understanding the types of cryptocurrencies. Bitcoin is the gold standard. The first, the biggest, and the most recognized. It's often considered digital gold because people hold on to it as a store of value. Then you've got Ethereum, which is more than just a currency. It's a platform that supports smart contracts, decentralized apps, and even NFTs. Beyond those two giants, you'll find altcoins, alternative cryptocurrencies like Solana, Cardano, and Polkadot, each with its own unique use cases and potential for growth. But picking a coin isn't enough. You need to understand the market. Cryptocurrency prices swing wildly, and that's part of the game. The key is knowing why. Supply and demand, news cycles, technological advancements, and even tweets from influential figures can send prices soaring or crashing. This volatility scares a lot of people off, but for smart investors, it's an opportunity. The goal isn't to time the market perfectly. Nobody can do that consistently, but to ride the long-term trend upward. Speaking of crashes, what if the market tanks? First, don't panic. Crypto is notorious for major drops, only to recover stronger than before. If you believe in your investments long-term, dips are buying opportunities, not a reason to sell. Remember, patience pays. Let's not forget taxes. Yes, even in the crypto world, Uncle Sam wants his cut. Depending on where you live, profits from crypto may be subject to capital gains tax. Keep records of every transaction, when you bought, sold, and how much you made. Tools like CoinTracker or Coinly can simplify this process. Finally, let's talk mindset. Because no investment strategy works without the right approach. Crypto isn't a get-rich-quick scheme. It's a revolutionary technology that's reshaping finance. Stay informed, stay patient, and stay disciplined. Avoid emotional decisions. Don't sell in a panic or chase the latest hype coin because of social media buzz. So, what's next for you? Are you ready to take the plunge into the crypto world and start building wealth? Remember, knowledge is your best defense and offense in this market. Take what you've learned today, start small, and scale up as you grow more comfortable. The future of finance is here, and now's your chance to be part of it. Hit that like button if you found this helpful, and subscribe for more deep dives into smart investing strategies. Let me know in the comments. What crypto are you most excited about for 2025? Let's build wealth together, safely and smartly. Don't forget to smash that like button if you got value from this breakdown. It really helps more people discover this content. Hit that subscribe button so you never miss out on more in-depth breakdowns like this. Share this with someone who needs to hear this, a fellow entrepreneur, a dreamer, or that friend who's stuck in the copy-paste mindset. Remember, don't compete, create. The future belongs to those who build it. See you in the next one. Now let's talk strategy. The safest way to start is with the dollar cost averaging, DCA method. This means you invest a fixed amount, say $50 or $100, every week or month regardless of the price. Over time, this evens out the highs and lows, reducing your risk of buying in at a peak. It's a long-term play, but it's proven to work, especially for assets that tend to grow over time, like Bitcoin and Ethereum. What about diversification? Putting all your money into one coin is like betting your entire paycheck on a single stock, risky and unnecessary. Spread your investment across a few solid projects: Bitcoin, Ethereum, and maybe a couple of promising altcoins. This way, if one project tanks, you're not wiped out. Think of it like building a balanced portfolio, but even the best investments are worthless if you lose access to them. That's why security is critical. First, never leave your crypto on an exchange long term. Exchanges can be hacked and accounts can be frozen. Instead, transfer your assets to a hardware wallet like Ledger or Trezor. These physical devices store your crypto offline, making them virtually hack-proof. Next, let's cover one of the most overlooked parts of investing: research. In the crypto world, people often fall for hype and FOMO, the fear of missing out. To avoid this, research every project thoroughly before you invest. Look at the team behind the coin. Are they experienced and credible? Technology. Does it solve a real-world problem? Adoption. Are businesses, developers, or other investors using it? Community. Is there an active, engaged user base? A strong project checks all these boxes. Okay, so you've invested, diversified, and secured your assets. Now what? Time to talk about profit-taking. Because at the end of the day, investing isn't just about holding forever. The best strategy is to take profits gradually. When your investment doubles or triples, pull out your original investment. That way, you're playing with house money, meaning any future gains are pure profit. And if the market crashes, you've already protected your initial capital.